Okay, good evening and welcome to FSM1 webinar on investing when market leaves no room for error. The case of bond amid AI Euphoria. So my name is Mark. I'm a client investment specialist from FSM1 CIS team. First of all, I would like to thank all the participants who registered and joined this evening webinar. So before we begin, a quick introduction to FSM1 and our parent company, iFast Capital. At FSM1, a single account gives you access to a complete global investment platform, start from cash accounts, unit trusts, stocks, ETFs, and bonds, managed portfolios, and insurance, all in one place. So iFast is listed on the Singapore Exchange and operates across five major markets like Singapore, Malaysia, Hong Kong, China, and UK. Serve over millions clients accounts. Our asset under administration reach Singapore dollar 30 billion, testament investors' trust and confidence in us. So now let's sit back and take a moment to watch a special video celebrating IFA's 25th anniversary, a milestone that we are truly proud of.
Once upon a time, people invested by filling up forms at bank counters. Shocking, we know. This story is an interesting one. It has no dragons or damsels in distress, but it does have a team that slayed the traditional way of investing. Starts in year 2000, when investing meant forms, queues, and asking a banker for help. Enter a small team with a wild idea. What if investing was not like that? So they built fundsupermarts.com. Suddenly, investors could compare funds, read research, and invest, all without leaving their desks. And guess what? People loved it, even the pros. Bankers were reading our research too. True story. But the team didn't stop there. In 2001, something happened. Singapore passed the Financial Advisors Act, and now advisors were free to offer clients more personalized and unbiased advice. iFast Financial was created, and a B2B platform was established for advisors to focus on advice while leaving the tech and services to iFast. Today, it supports over 800 companies. By 2004, iFast turned profitable. By 2005, first $1 billion in assets. 2006 to 2014 was all about expansion. Hong Kong, Malaysia, China. And in 2014, iFast got listed on the SGX mainboard. And in the years that followed, it wasn't just about funds anymore. There were bonds, stocks, ETFs, you name it. And a few years after IPO, iFast Global Markets was created to showcase how wealth advisory can be driven by a focus on simple and transparent investment products. iFast's IT DNA shone through. Custom-built platforms, mobile apps, and a whole tech team that made it all happen. In 2015, they launched the IT partnership. Today, 1/3 of the company is IT. And then in 2022, iFast acquired a bank to propel its vision of a truly global business. iFast Global Bank, a UK-based bank, was added to the iFast ecosystem. In 2023, iFast Global Bank launched digital personal banking. Now, clients around the world can save, spend, and send money all with one multi-currency current account. Remember that fund supermarket? Well, it's now grown to be a global digital banking and wealth management platform. Not bad for 25 years. So, how did we get here? Well, it started with a question, and the story's still being written.
And with that, we would like to thank each and every one of you being a part of our 25 years journey, and for your trust and the support truly mean the world to us. And the journey is not end, it's still going on, and let's we travel together. Okay, now on to today's theme. Market been roaring. Okay, it's a sky high. And but as Warren Buffett remind us, be fearful when others are greedy, and greedy when others are fearful. So this evening, we will look on how bond can anchor your portfolio, offering stability, cash flow, and opportunities even in uncertain times. So to help us to unpack that, we delighted to have Mr. Tan Dao Hong, General Manager of Fund Supermart, here with us today. So Mr. Tan joined iFast in 2018 and now leads Bond Supermart mission to make a bond trading more accessible through an innovative electronic platform. So he holds a postgraduate degree from University of Nottingham, Ningbo, China, and is an associate member of Financial Market Association of Malaysia, Persatuan Pasaran Kewangan Malaysia. So throughout the webinar, let's say if you have any questions or doubts, you can drop your question in the Q&A tab to let Mr. Tan to address it later. So without further ado, let's join me to welcoming Mr. Tan.
Thank you. Thank you very much, Mark, for the introduction. I'm just requesting to share my, okay, I can share my screen now.
Yeah.
Okay. Just a quick check. Everybody can see my screen and hear me loud and clear. Okay. Good evening, everyone. It is indeed a pleasure, I guess, to have so much of you joining us, tuning in tonight. Again, Mark introduced us by celebrating our 25th anniversary. Again, on behalf of the group and also Bond Supermart, I thank you all for the journey together. And there's much, again, we are at a juncture where a lot of things are happening around us, and I hope our theme today, investing when market leaves no room for error, can bring you guys some actionable insights, what to do when we're looking at the things that is happening around us, right? And of course, the main spotlight today will be on bonds. Just a quick introduction to who Bond Supermart is. I guess everybody has that question in your mind. Bond Supermart, is it affiliated to Fund Supermart? Is it affiliated to iFast? Yes, we are a subsidiary of iFast, and we are on a mission to connect bond investors globally. But again, we are not a platform that directly serves the retail client. You cannot come to our website and open an account to trade bonds. You're already doing that through FSM1, but we're powering and enabling the market players. You can think of us like the Bursa Malaysia that is powering the stocks exchange. We are Bond Supermart, just as easy as trading stocks today. You can also probably towards the end of my sharing, I'll be doing a small demo on our website, and also showing you how to what are some of the navigations interfaces that you will be interested to find out more. Okay, with just some housekeeping, very quick housekeeping. Whatever I'm going to say for the next 45 minutes is just for us to learn together. It's just for references. It is not a recommendation to buy or sell. And if you need any sort of tailored advice, do reach out to our client investment specialist like Mark, or whoever that is the name in your the bottom of your account. If you log into your accounts today, if you scroll down, there is actually a dedicated CIS client investment specialist, which name you can reach out and contact, and they are taking care of your portfolio. So do reach out to them. They are They are our investment specialist that is taking care of your accounts. Okay. I will go through our journey today in 3 parts. Right? Of course, I want us to be able to understand what are bonds. Part one, I will make sure that everybody walks away from this session understanding the essence of bonds, right? And you'll be able to know some of the important concepts of bonds. In part two, I will move on to share one very important question, right? Which is to ask ourselves, where are we today in terms of markets, right? And if we are able to answer that question, then we are able to be more confident in positioning ourselves for the future. So that is a very important question that I want to address in part two, which hopefully can drive our decisions to move towards bonds a little bit more. And the reason why I'll share a little bit more in part two, and we can take action much more urgently. And part three, I will just quickly show you guys some of the ways to invest into bonds, right? If you are today a newbie, right, you have no what idea how to start, right? I'll just share some ideas about how to, what are the safest bonds to invest, what goes on after that, what are the options and alternatives. Then I will do a quick demo on the FSM website to let you guys know where can you actually find bond ideas and what are the trading interfaces like. Okay, we'll jump straight into part one. What are bonds? Before explaining about bonds, I just want to take a quick, 30 seconds to talk about equities, right? Because equities is much more familiar to everybody. We all have bought shares and equities and stocks before, right? As simple as inside your palms, you can do it already. But what does it mean to actually own a stock? Have you asked your questions? Have you asked yourselves that question before? Owning a stock, what does it mean? If you own a stock, it means that you have become the owner of the company, right? Because you're investing and you have become the shareholder of the company. And as an owner, you will always hope that the company becomes the next what? Tesla. The company becomes the next Nvidia. The company becomes the next Microsoft or Amazon, right? Why? Because as an owner, as a stockholder or a shareholder, you're entitled a share of the profits of the company in the future. So you want it to keep getting better. You want the company, as the young people like to say, to go to the moon, right? You want the companies to go to the moon. On the other hand, what are bonds, right? If there's one word to explain bonds very appropriately, it's debt, right? It's the debt of a company. But in order to describe the spirit of bond, I would use the word contract to explain what is bonds, right? Essentially, bonds are contract between a borrower and a lender. And just like how we go to the bank and ask for a mortgage so that we can buy a home, there is a contract, right? If we don't pay up, the banks would actually take our homes away and they will auction it off and try to recover value, right? Again, bonds are a contract. And in the spirit of a contract, everything is black and white. And during our course of advising investors investing in bonds, that spirit of making good the promises within the confines of the contract, the incentives are always very high, which means that people do not like to default on their bonds. Business owners do not like to default on their bonds, right? Legitimate business owners. And the reason is very simple. Imagine you and I spend so much of our blood and sweat and tears building this business, right? If you default on a bond, the bondholders can go after your company. They can sue your company, wind down your company, take over your assets, sell those assets, and recover their money. And in our journey of investing in bonds, we have observed that the owners of the company, in normal circumstances and in legitimate circumstances, they will go to the ends of the world to find money to repay bondholders. So this is indirectly saying that the incentives to default on bonds are very, very low, and you don't see much companies defaulting on their bonds in Malaysia as well, right? But if you have questions about that, do put it in the Q&A. We have a lot of, maybe at the end, we can address some of your questions in your mind, right? There's no such thing as a free lunch. I want to share this quote, which is an important quote, because the next question I'm going to ask is, what is the price of money? Have you ever thought about this question? What is the price of money? And the answer is, the price of money is interest rates. Right? Follow me? There is a cost to your money, and that cost to your money is interest rate. And today, in today's environment, interest rate is higher than we were 5 to 6 years ago, right? And that leads to my next slide. If you are a borrower, imagine if you are a business owner today and you want to expand your business, you need to go to the bank and ask for a loan. And when you borrow money from the bank, the interest rate, the cost of your money is going to be higher today. And what that means also, as a business owner, you will have to squeeze more brain juice to think about how to invest that money more productively so that you can earn a higher return to not only cover the interest, but also make a profit, right? So people are becoming more and more careful with their money when interest is higher, when the cost of money is higher. But the good news is, let's say we are on the other side. We are savers, we are investors, we have extra money that is sitting in the accounts. And what we can enjoy today in this high interest environment is the higher interest that we will earn if you lend your money out. And this is the good thing of buying bonds today, because generally the interest rate that you're getting around this climate, around this higher interest environment, is higher. The absolute return is higher, right, than 5 to 6 years ago. Next, I want to share one very important concept to everybody, and I hope this is, if we don't remember anything, this is one of the concepts that you remember after we walk out of this session. The relationship between bond yields and bond prices, or the relationship between interest rate and bond prices. If you look at the visual, probably you'll be thinking, okay, one up, one down, one up, one down, right? But let me walk you through one example, very simple example. And you can remember this concept for the rest of your life, right? Imagine today you and I, we are holding a bond that is paying us 5%, right? You and I, we're holding a bond that is paying 5%. Tomorrow, when we wake up, Bank Negara, our central bank, suddenly announces that the interest rate is going to be 6%. Now it's 6%. Which one of the bond is better? The 5% bond on our hands, or the new bonds that is going to be priced in the market for 6%? This is a very simple question. Of course, the 6%, right? Because 6% is higher than the 5% in our hand. So what happens to the 5% bond on our hand, which is not so attractive anymore? People sell things that are not attractive. And when people sell things, the price of the thing goes down. This is what we say by, if interest rate goes up to 6%, your bond value or the bond price goes down. Okay? Flip it on the other side. Let's go through this example again. 5%, you and I, we are holding this bond. Tomorrow, when we wake up, Bank Negara announces that the interest rate is going to be lower. This time, it's going lower to 4%. Which one of the bond is more attractive now? Is it the one 5% on our hands, or is it the new bond that is going to be priced in the market for 4%? Again, this is a very simple question. It's the 5% bond that we have on our hand, which is much more attractive because it's higher. We're getting a higher return. And what happens to things that are more attractive? People buy the bond, right? When people buy something, the price of that thing actually goes up. And this is what we mean by when interest rate goes down from 5% to 4%, the interest rate environment goes down, the bond price goes up. So if you want to understand bonds and how bond prices move, it's always relative to the surrounding, right? And this is the most important concept that you need to know. And you will probably understand the concept if you follow the example just now, okay? After talking about the relationship, let's talk quickly about some risks, right? There are a lot of risks here that I listed out, but I'm going to just go through two kinds of risks. And the first kinds of risk I'm going to talk about is credit risk. The reason why it's the most straightforward risk that you will face when investing in bonds. And the question you ask is, what is the most fearful thing or the most scariest thing when you invest in bonds? Is that you cannot get back your money or you don't get back your money. End of story. That is credit default risk, right? When you think about credit risk, you think about how well somebody can pay you back their money because you worry that they cannot pay you back their money, right? There are some shortcuts in order to assess that. If you look at the right, you have credit ratings, right? Credit ratings are guidances provided by credit rating agencies. In the international scene, you have S&P, Moody's, and Fitch. These are the big threes. In the local scene, you have RAM, rating agency, Malaysia, and MARC, Malaysian Rating Corporation. Right? These are the two local rating agencies that are rating Malaysian entities that are issuing bonds. Again, these are just guidances. Right? These are not the Bible. The rating agencies relies on public information to give these guidances. If the public information is not reliable, they could be giving some unreliable guidances as well. And if you remember in 2008, they were part of the reason why some of the very lousy loans are given a AAA rating still, right? But that's a story for another time. On your left, you had seniority, right? If you're assessing how well you're getting paid, you will also want to know, in the case, if it really goes down, when would you get your money? So seniority means that you're getting your money because you're senior, you're getting your money first. If you're junior, you're getting your money much later. And if you're senior, because you're getting your money first, you're probably going to get a lower return because you get safety, right? This is the trade-off. If you have safety, you get a lower return. And if you're junior, you're getting your money later, you don't get the safety, but you get a higher return, right? This is generally the ideal. But one thing I want to highlight here is you could see this word secured hiding inside, right? And the word secured implies there's security behind the bond. And the most important question is not to stop here, right? Because if some people, they say, oh, it's secured, it's a good bond. The most important question to ask is, what is the security, right? There's only two kinds of security. One is tangible. Tangible means that you can touch it, you can feel it, it's physical. Things like property, things like land. These are all physical securities, right? Tangible securities. And these are very easily valued. There are also intangible securities. And intangible securities, examples of those are cash flow. Let me tell you an example. If this bond is actually backed by the contract of a solar power plant or a solar farm, right? Usually power plants, no matter if it's solar or coal, they have a long contract with TNB, right? Every month they generate electricity, whether through the sun or through coal firing plants. They sell the electricity on a monthly basis to TNB. And these are long-term contracts. And what is being secured here is the future cash flow. If the project or the contract is actually securing the bond, they are securing the future cash flow of the project to bondholders. These are sometimes intangible. What are some other examples? It could be receivables. Receivables are like what? Buy now, pay later. Does this ring a bell? Every one of us, when we go on Lazada and Shopee, we actually buy things and we split it into 3 months, 6 months installment without interest, right? Lazada and Shopee can pull all these invoices together and package it and sell it to investors. And the investors, what are they relying on? They are relying on the monthly repayment, which is future cash flows that is going into this part, buy now, pay later invoices. So these are also examples of security. So just remember to ask, what is the security, right? So what happens when things default, right? When a bond defaults, there's only two things that can happen. The first thing is that very simple, straightforward. The company closes down, the company liquidates, the liquidator sells the company's assets, and they pay the money back based on seniority, right? This is very straightforward. There's no two ways about it. If there's no salvage situation is unsalvageable, they will just go in, appoint a liquidator, sell the assets, get back the money. This is number one. This is one of the ways. Second thing that can happen when a bond defaults is what they call debt restructuring, right? Debt restructuring means that the company intends to continue their business. They want to continue as a going concern. They want to continue business. They are telling the creditors, guys, I'm having a tough time. I need some room to breathe, right? Can we agree to some resolutions, right? This is a negotiation process between the issuer, the bond issuer, and all the creditors, including bondholders. You could also negotiate with your suppliers. You could also negotiate with banks. You could also negotiate with your salary, right? Your employees who you owe some salary with, right? If you're genuine, you put up a resolution that is sincere, it will go through a vote, right? And if the vote is voted down, meaning the resolution does not get passed, then it falls back to way number one, right? The company closes down, the assets are being sold, the money recovered is going to be repaid based on seniority. But during the debt restructuring process, there's usually some things that could happen. One is haircuts. Haircuts means that, okay, today I have 100, I owe you guys 100 ringgit. But sorry, if you want this thing to continue, I'm only really able to pay you back 50. Are you willing to take the haircut, the 50 ringgit haircut? If not, if you force me to liquidate, then probably you won't even get back this 50, right? This is haircut. This is what is meant by haircut. Debt to equity swap is another way that can happen. It means that from a bondholder, you are actually converted into a shareholder. So meaning your relationship with the company has changed. You are not a bondholder anymore. You become an owner of the company. And how would you recover your money? Is by the company doing well in the future. And when the share prices recover or goes up, then your value will recover. So this is a different way of restructuring the debt, because simply the company cannot continue surviving having so much debt on their balance sheet anymore. So it's either by hook or crook, they have to find a way to reduce it, either through haircut, reducing it, writing it off, or by converting it from a debt to a share, which is capital. Right? Just some idea here. The next risk I want to share is about interest rate. So interest rate risks are more important to bonds that are already safe. Can you follow me? Means that if you buy into a high quality company, right? You know these are maybe bank papers, maybe insurance companies, highly regulated industries. When you look at these bond papers, you know they are very solid, but there are also one kind of risks that these solid bond papers are exposed to, right? And that is interest rate risk. They are much more sensitive to interest rate movements. Just like how we went through the concept just now. Remember the 5% and the 6% and the 5% and the 4%? Let me use this example to paint an extreme picture of what could happen, right? When you're facing an extreme interest rate environment. This is an Austrian government century bond, right? It's issued by the Austrian government for a century, which is 100 years. In the year 2020, it is issued, and the maturity date you can see here is 2100, the year 2120, right? This is for a century. And the next question you want to ask is, how much are these bond investors getting paid? Right? And you can see the information here is the coupon rate is 0.85. And you will start thinking in your mind, are these people crazy? Are they out of their mind? You're lending 100 euro dollars to the government of Austria, and every single year you're only getting 0.85. It's not even 1 euro dollar. So you might be thinking, Tao Hong, is this true? Right? What are the people, what are the investors thinking about back then? And I would share to you that there's no stupid people in the market. Every single decision is a rational decision. And the reason why people are willing to lend the Austrian government their money in the year 2020 is because during that time, interest rates were ultra low. We are in an ultra low interest rate environment. And it went down as low as a negative interest rate. A negative interest rate is not, I have not heard about it and learned about it in school, right? When we were studying economics, when we were studying finance, there's no such thing as a negative interest rate. But in reality, we had that period of time, which means that if you put your money inside the bank, the next day you wake up, the money has already become lesser. This is negative interest rate, right? And if you take this example, 0.85, we are holding 0.85 of bond on our hand today. And tomorrow, suddenly, the interest rate environment rises to 5%. That is what happened, right? Remember when US raised its interest rate after COVID? It raised its interest rates in a span of 12 months to 5.25%. Remember that period of time? Imagine what happens to the 0.85 bond that you and I have in our hand. It's gonna be sold off very severely. And this is what you can see. What I mean by interest rate risk, right? People has been too comfortable to think that the ultra low interest rate environment would always continue to be the case. They underestimated the interest rate risk. We have enjoyed a very good part of the decade, enjoying very low interest rates since after the subprime crisis in the year 2010. We started going into a very, very low interest rate environment for the good part of the decade. But people always underestimated and thought that things would always continue the way it is. And COVID caught up with us. Now, in hindsight, we know, right, there were supply chain issues. It wasn't transitory, right? All these things is a lesson for us. Okay, but today, if you're not holding this bond and you're saying, okay, I want to buy this bond, how much can you buy at? Yeah, probably it's trading around 30 cents to the dollar, meaning you're using 30 cents to buy something that is worth $1, right? And most of your returns, most of your capital gains will be happening at the end of the life of the bond. Every year, you're still getting this 0.85, right? But if you hold it to maturity in the year 2120, the Australian government will pay you back 100. And that is where the bulk of your return will come, right? If you hold it on. Some people might trade this bond, right? They say, okay, I'm going to buy it at 30 cents to the dollar. I'm expecting the interest rate to come down. Probably it could have a capital gain. Then I'll probably be happy to sell it at 50 or 60. I'm doubling my money, right? This is also possible. But this is just to illustrate interest rate risk. Okay, the next slide, the last concept before we go to part 2 is the pricing of a bond. And if you look at this formula, you will start to vomit because the numbers in the formula are less than the alphabets in the formula. Right? And this is mathematics, right? The more advanced you go, the lesser numbers you deal with, right? The more ABCs you deal with. And if I explain this formula, it is the present value of all the future cash flows discounted to today, right? If you take all the cash flows, the 6 months coupon, the 1 year coupon, the 1.5 year coupon later that you will be receiving, and all the principal that you'll be receiving at the end of the life of the bond, and you discount it to today, then you will get a bond price. And you add them all together, of course, then you will get a bond price, right? But if I tell you like this, you won't remember. I'll explain it in another way so that you can remember. I'll use this analogy called Lego, right? Do you guys know what is Lego? Lego is actually built layers by layers, right? During our childhood, we play Lego a lot, right? We try to build layers and layers. And the very first layer of a bond price or the yield for you to understand is what we call the risk-free yield, the risk-free rate, meaning the base will always be formed by the safest yield that you can get. And the safest yield in the context of a country means the government, right? Today, if you and I go and lend our money to the Malaysian government, probably they will give you 3%, for example. And if you want to lend your money to other than the government, not the government, you would certainly ask a higher return. So the first layer, you will say, okay, I know I give the government my money, I can already get 3%. Let's say today, if you want to lend your money to FSM1, Fund Supermart, iFast, in your right mind, you will demand something that is higher than 3%, maybe 6%, right? And that difference between the 3% government rate and the 6% that you're asking is basically the risk of investing into iFast as a company, right? Because iFast runs a platform business, there's operational risk, there's risk related to the industry. There's also risks of liquidity that is embedded in that additional 3%, right? How easy it is for you to buy and sell the bond, right? If you're stuck with the bond, then probably you want to demand a higher return because you know getting out probably could be a problem. So these are all the risks that the market consensus forms in the yield, right? We say priced in, everything is priced in. So remember, if you look at the yield, it consists of 2 layers. The first layer, the safest layer, is called the risk-free asset, right? And the returns above the risk-free asset is basically the risk investing in the corporate, in the industry, or even in the liquidity of the bond. Okay, so I hope this helps you understand roughly the concept of how a bond price is formed. Okay, now comes our part 2. I want to take a moment to remind us, right? And again, to ask this question, where are we today, right? Because this quote is very, very important. We might not know where are we going, but we sure as hell ought to know where we are, right? Because we cannot analyze the future. There's no such thing as analyzing the future because it has not happened yet. The only thing that we can do today to get a handle of the future is to look at what? Is to look at the past. And history is our best teacher to tell us what to do if we are faced with the same situation today. Right? Of course, a lot of people will bring that quote and say this time is different, right? There could be times that are different, But let's look at what the history tells us today. This is a chart, and this is a S&P 500 chart. And this is also a S&P 500 chart, forward PE ratio chart. What does S&P 500 means? It means this is representing the largest 500 companies in the US market, right? What does forward PE means? PE means price. E means earnings. P divided by E, price divided by earning, means that how much you are willing to pay for $1 of earnings. Are you following me? So the whole thing, when you put it together, means that what is the market willing to pay for each earnings of the largest 500 company in US? Okay, so this is a chart to say that how much the market today is willing to pay for each dollar of earnings of the largest 500 companies in the US market. And today that number is around 22 and 23. Oh, by the way, this study is done by JP Morgan. It's not done by me. And it looks at the situation like this from 1987 to 2014. And the conclusion is that if you buy into a market that is valued at 22 to 23 times PE, price to earnings ratio, which is roughly the PE ratio today, the next 10 years, your return will be between -2 and 2. I'll repeat myself again, right? Slowly this time. From the period of 1987 to 2014, the study concluded in every single instance, there's no exception, when you buy into a market that is giving 22, 23 PE, the next 10 years, every single year, your return is going to be between 2 and -2. So what is it trying to tell us? The lesson is sometimes it's not about what you buy. Sometimes it's about how much you pay as well. So there is an important aspect of how much you are paying to enter the market here. And if we can conclude and we can come to an agreement that today's market is rich, right? I'm not saying the word bubble, right? Or even the word overvalued, right? Because things can continue to become overvalued, right? And the bubble can continue to grow into a bigger bubble. But if we can agree by looking at history, it tells us that the current market, by historical terms, is rich. What should we do? Right? Should we continue to hit the home run, to go for the offense, to score the goal, to pick the winners? Or is it time to look at our portfolio and say that, okay, let's trade off a little bit of risk and let's get on the side of defense. Let's shift our posture to a little bit of more defense in this kind of climate, right? So this is a question that I pose to all of you, right? Look at your own portfolio. Look at how are you allocating your investments. If you feel and you agree that the market is lofty, right? Lofty but not nutty, it's lofty. Do think about shifting your posture to a more defensive posture, right? Meaning it's time to sell some of the riskier equity investments. Possibly you can allocate more into bonds investments, right? That are more defensive and more certain. Right? This is the framework that I'm saying. What can you do today? It's a very simple framework that is not taught by me. It's taught by Howard Marks, one of the legendary investors investing in distressed bonds. He said that at least for now, if you agree, stop buying, right? Stop chasing the home runs. Stop piling your money into risky assets. The next thing you can do, reduce some of your aggressive holdings and increase some of your defensive holdings, which means buying more bonds, right? And to conclude my part two, I just want to share 3 points as a summary, right? The first point is that in today's terms, remember that I started the sharing session by saying that we are in a good time if we are an investor because the interest environment is higher today, right? And that means that the absolute return that you are getting from investing in bonds is going to be higher because the interest rate is higher today, right? The starting point is higher today. This is point number one. Point number two, it's very competitive comparing with historical equity returns. What I'm trying to say is also trading off the risk, right? If you put your money in the equities market long enough, let's use the S&P 500 for an example, right? If the study tells us that if you put a money in S&P 500 for 100 years on average, you're going to get 10%, right? But that 10% on average does not mean that 1 year is 8%, the next year is 12%. Some years it could mean up 30%. Some years it could mean negative 30%, right? We say that the average is not the norm, right? And that also means that there is a good question that you should ask yourself. And the question is, it's important to know how much you're paying to get into the market as well. So 10% on a long run average, are you willing to trade off to get a 6% solid returns for the next 3 to 5 years so that you can sleep well at night? You can actually worry less about your portfolio, look less at your portfolio and live your life. So this is the question that I pose to all of you. Right? It's competitive. Bonds returns are actually very competitive. If you take slightly a higher risk, probably you can get 8 to 9% kind of returns in a portfolio. And the third and most important point is the spirit of the bond contract, right? It is supported by a promise to pay the interest and the principal. And throughout our years of advising people investing in bonds, there is of course a fair share of defaults that we've gone through ourselves. But in a matured market, in a legitimate business, we have seen businesses going to the ends of the world to get money, right? To find the money to repay investors. And that's mostly the case. Okay. So this is the start of my part three. Part three, I'll go through very quickly. I just want to answer a very simple question. Today, if you don't have any idea what to buy, right? You said, okay, Dao Hong, I agree to some of the things that you say, but I don't want to start with a big amount. What can I start? What is the easiest thing for me to start? Right? And the easiest thing for you to start is actually investing in government securities because that is the safest. Remember the risk-free rate, right? If you want to dabble in it, you want to start investing a little bit of your money in it, look at government bonds, right? Government bonds in Malaysian terms is Malaysian government securities. You can buy into them as low as 1,000. If it's in US, it's called US Treasuries. US Treasuries are traded in as low as 100 today. And if you saw our campaigns just now, there's an ongoing campaign to the end of this year that we are paying for 3 transactions that you buy US Treasuries as a minimum of 100 nominal. We are giving you $5. So it's for you to incentivize you, to encourage you to get a feeling of buying and selling US Treasuries. Right? Of course, some people will use it and US Treasuries when, let's say if you take profit of your US stocks and equities, where can you put your money if you don't want to convert it back to ringgit? Because ringgit has weakened throughout the year, right? You said, okay, I want to keep my money in US dollars. I want the safest bond that I can buy US Treasuries, right? Maybe you can buy something that is not too long, right? 8 or 9 years seems like a fair kind of duration, right? So starting point, US Treasuries. If you want to take a little bit more risk, naturally you will go to corporate bonds, right? And I just want to quickly touch on this slide, building your cash flow, because bonds are different than your bond funds. Your bond funds distributes income to you in the forms of units, right? It continues to fluctuate. The NAV continues to fluctuate, and you need to sell your bond funds to realize the cash flow. But for bonds, it's straightforward. Every 6 months, you wake up on that day, you will see the cash in your cash account, and you can use that cash to plan either your retirement, you plan your life, plan your spending or whatsoever. So cash flow, from a cash flow perspective, having bonds is a more direct experience, right? There's no there's no different ways of enjoying your income. This is exactly paid into your cash account, and you can withdraw that money to live your life. Okay, so this is just a slide to say that we can diversify into bonds as well, right? You can actually build your own bond portfolio. You can diversify in terms of length of the bond. You can buy some bonds that are 3 year, 5 year, 10 years. On average, you get a decent duration, right? Because longer bonds generally pay you better, right? So you can have spread out all your different into different durations and maturities. This is one way to diversify. Second way you can diversify is that you can diversify also into different currencies, right? You can say that, okay, if I look at US dollars, the US dollar is not looking so great, but the asset pays me well, maybe I can have a little bit of exposure inside. Then you move on to another currency. You say that, okay, let's look at Sing dollar. Sing dollar has been historically a great and stable currency. Currency-wise, it's a positive, but the asset return, the bond returns, they are only paying 2 to 3%, not so attractive. Maybe I can also have a little bit of exposure. Then you move on to the next currency, right? You look at Aussie dollars. Aussie dollars is interesting, right? Because it has come down from a high of 3 Aussie dollars, 3.1 Aussie dollars. Now it's trading at what, 2.7, 2.6-ish against the ringgit. It's hovering around there for the past 6 months to 9 months. It seems like a good time to accumulate. The currency wise has some value, right? Right. And you look at the asset returns. When you look at the bond returns that the bond Aussie dollars is paying you, you get 6%, close to 6% of high 5% when you buy into a high quality banking bond. This is a great, possibly great combination of a valuable currency, possibly, right? That with some value, a currency that has some value, and also a currency that pays well and decently in their bonds returns, right? They can pay 5 to 6% for a very solid banking bond. The top big four banks in Australia, your ANZ, Commonwealth, NAB, even your Macquarie's, these are all within that options. So there is this kind of option in the market as well. So diversify so that you can consistently net maybe 5 to 6%, and you don't have to worry about it, right? Because when the market comes down, probably the interest rate comes down. If we come through a recession, your bond portfolio would benefit as well, right? Okay. Here comes the time where I quickly want to show you our website. I will quickly go to our website and show you some of the places for you to explore the website, right? So this is our homepage, right? If you come to our homepage, you can see there's a lot of things here, right? But I'm just going to zoom in onto bonds, right? You can directly click onto bonds, or you can go to discover, you can go to bonds. It comes to the same bond landing page, right? Inside the bonds landing page, you'll probably see a lot of these things, right? And you'll say, okay, Tao Hong, point me to what I can buy immediately. Actually, these are all that you can buy immediately. Bond Supermart Live is what we are doing just now. We are trying to give people experience of a real-time trading, just like stocks. So these bonds that are listed on this market, Bond Supermart market, that it is traded during market hours, normal market hours. It opens at 9 it continues to trade up to 6 o'clock every market day. Right? This is where you can trade your US Treasuries, participate in the campaign to get your $5 US dollars for up to 3 trades. And you can also find a lot of other ideas here. So if you click into it, right, you can see, okay, Bond Supermart Live. You can also filter for currencies. Let's say there's actually one Aussie dollar bond on our marketplace, right? This is BPCE. It is a French banking giant that pays close to 6%. Right? If you click into the fact sheet, you can actually see it's actually yielding close to net, including fees, everything is giving you 6+%. This is not too bad, right? It's a very large French banking French banking group, right? And the reason why it's paying so high is because the government the country is also going through its own political kind of turmoil, right? But the credit is good. It's diversified enough. It's large enough. It's a globally systemically important bank. It's paying you 6+%, and you can buy as low as 5,000 Aussie dollars. So you can come here, look at it, look at the live trading tomorrow at 9 o'clock. It starts trading again. And if you want something else, maybe you can go to Bond Express, right? And the thing with Bond Express is that in the future, slowly Bond Express will be phased out because everything Bond Express does here is just like 99 Speed Mart. You go to the market, you go to 99 Speed Mart, you pick out the Milo, you go to the counter and pay, right? You see this price, you go to the counter and pay. But for Bond Supermart Live, it's actually a marketplace where you can negotiate, you can queue, just like how you buy stocks. You can see the market depth, right? You can see the rest of the market participants, where are they queuing. You can also counter the price with your own desired price. So that is a much more evolved version of trading. And in the future, Bond Express will slowly be embedded into Bond Supermart Live, right? And the thing that we make sure when you come to Bond Supermart Live to trade is that the liquidity, the ease of you buying and selling bonds is always very, very easy, right? You can come in, you can see the prices, you can see the volume, you can immediately buy and sell, right? You can decide to queue, but if you want to immediately buy and sell, the spreads are good, the volume is there. So this is what we are striving to provide for our investors, right? If you go to another place, probably, if you go back to to this website, there's other things within the landing page. Some are highlighted in the research. You can read some of our articles and look at the bonds that they are pointing to, right? This is Tropicana. Recently, Tropicana issued a 3-year secured bond that is paying around 5.8%. Now it's trading slightly above par, but it's still good to look at because there's land security. There's actually tangible security around it, right? Some companies may not be so positive, but the bond is actually a good bond, right? Because they are backed by securities. And some people might not be able to digest that, if the company is not good, the bond confirm is not good. Actually, in some cases, I will argue otherwise, right? Some companies may not be good, but the bonds can be good, right? Given that there are certain conditions that it meet. And this one is one of the cases which I feel that the land security actually gives the bond a very, very good and credit enhancement. So this is where things are highlighted in the research. You can look at some of the things. If you are a reader, you can look at the summary or whatnot. But if you want to look at new stuff, these are new stuff. Bond IPO means that what is currently new in the market. New means that it hasn't been fixed yet. So you can see some guidance here, right? Yinsen 5-year guiding around 4.8 to 5%. And these are new issuances that are in the market that is book building. They are trying to gather the orders and they're trying to close the books. Right? So these are new things. Of course, if you scroll down, there are other things like our bond collections. It's basically some shortcut to filter some of the bonds that you can search. Okay, so I'll just stop here and return to my slides to close off our sharing. One moment, yeah. Okay. Okay. So I was just saying, this is already at the end of my sharing. If you guys have any questions, please feel free to put it in. But before I go to the questions, I want to close by asking this question, right? What is the end game of investing? And probably in your minds, you're thinking about, okay, I invest because I want to retire earlier. I invest because I want to become rich. These are all plausible answers, right? Allow me to share my version of the answer. I've also taken reference from one of the very great um, value investors called Aswath Damodaran. He's a professor in NYU Stern Business School. You can go on Google to hear him talk about a lot of value investing stuff. It's quite remarkable. And his answer to this question is that the end game of investing is to preserve and grow your wealth. And there's a reason why he says that the end game of investing is to preserve and grow your wealth. It's because if you start your investment journey with a different mindset and you say that you want to retire, let's say I'll give you an example. I'm 30, I'm over 30 this year. I want to retire by 50 years old. I have 20 years ahead of me. And every year I need to achieve this return so that I can retire and get to my target. Not every day is Sunday. There are times when market is not good, right? And if I'm facing a market that is not good, probably what would I do if I say that I need to retire by age 50? I would probably make speculative or riskier bets than I'm supposed to in order to meet those kinds of timeline. I'm also going to overreach, and overreaching means that you're probably going to concentrate a lot of your portfolio in something, right? Over concentration, right? Because you want to make up for the lost time in a bad market, right? So if you start your journey in investing by saying that I want to preserve and grow my wealth, then most likely the behaviors that will follow you will be something that will not put yourself in a position that would ruin your lifestyle, right? So it's very important to have a very sound mindset of investing. And my answer to this question is the best answer that I've heard is to preserve and grow your wealth. And you can use bonds to actually achieve that, right? And in fact, I want to make a bold claim here that the first investment that everyone should buy is to buy a bond. It's not unit trust, it's not anything. It's to buy a single government bond first, right? Every 6 months, when you get the cash flow, then you understand what it means by what I'm saying, right? Because it comes to your account very consistently and predictably, right? If the bond price goes down, doesn't matter. You hold it to maturity. You know that the government is going to be around. You continue to enjoy the coupon rates and the cash flow. This is what I'm saying about certainty, right? Predictability, stability here. Okay. Okay. I can go over to the questions and answers. We're a bit over time here, but I think we appreciate all the questions, and I see that the participants are still hanging around to hear what we have to comment about some of the questions. I'll pick up some of the questions directly. Just give me a moment as I scan through some of the questions, and I will try to answer as much as possible. I don't think I can answer everything, right? Maybe I'll start from the very top, right? With the market uncertainties and noises worldwide, I am having doubt to invest in bonds. Am I right to think that way? I think if we look around us, if the market is uncertain, you probably want to invest in something that is more predictable, much safer. So the straightforward answer to this is that if you are comparing just equities and bonds, then of course, in a market that is much more uncertain, people would turn.
I think there is some connectivity, internet connectivity issues at Mr. Tan's place. Let's give a few seconds and see.
Oh, I'm sorry, I got disconnected. I'm back.
Okay, yeah, can.
Okay.
Yeah.
So sorry. I'm not sure why the internet just popped me off. Let me continue with the next question. I'm thankful that some of you are still around. Let me continue by looking at the next question. As a retiree, which type of bond should I consider for regular income and ensuring that it beats the inflation risk? I think beating the inflation risk is, of course, an objective of buying bonds, right? If you don't beat the inflation, probably your bond price will go down as well, right? This is how the market would think about buying bonds, because at least you need to preserve the purchasing power of the bonds. Generally, I would say that if you maintain you got to think about this problem in the long term, right? You got to ask yourself, in 30 years or 50 years of statistics, what is the average kind of inflation? Then if you are able to have that to anchor your investments in bonds, then probably you have an idea how much you want to aim for, right? So if you put it in I think this is a question that you can ask Google for the past 50 years, what is the average? Let's say if you want to look at Malaysia as well, you can ask in a Malaysian context. I would put that number probably around 3 to 4% average inflation for the past maybe a long term. So if you are able to get 5 to 6% every single year on a diversified portfolio, that should be a decent target to achieve. Okay. Okay. So I answered a couple of them. Let me look at the next questions. How many ratio percentage of my portfolio should be in one or more bond? I am retired now with no active income, and you have a good sum of money on hand, right? The percentage depends on what does liquidity means to you, I would say, right? Because you're at an age where you need the cash flow, right? I would assume that you will probably be able to live off your interest very, very conducively, right? With that amount. So if you're not worried about having any problem of income, right? Maybe I would suggest, because it comes back to the question of the willingness and your ability to take risks, right? You said that you're retired. I would say the ability to take risks probably is lesser, right? The willingness probably is still there, but again, as you age, the willingness would reduce as well. So if we conclude that the willingness is low and the ability is low, then you should probably have a much, much higher proportion of your money in bonds compared to equities, right? How much of it, again, is a very personal circumstance. You can reach out to our client investment specialist. I would put it at least you got to have 60 to 70% of your money in bonds, that would actually assure you of the retirement cash flow that you are planning yourself in to get every single month or even spread out every 6 months and all that to be able to live your life comfortably, and you don't have to worry about your investments, right? You can buy into very solid big banks that pays you very well, 6% a year, and probably you already got your cash flow sorted out for your livelihood. So I would put that around 60 to 70, a majority, definitely more than 50% of your money should be in bonds. Do we need to perform switching when investing in bonds? Generally, not so much, right? Unless there is a better option out there, you can actually sell your bonds or invest into another asset, or even sell a bond to invest into a better bond, or lengthening the duration of the bond. Let's say, for example, you've held this 5-year bond for 3 years. Right? After 3 years, there's only 2 years left. You say that, okay, I want to sell it now because the bond is in a capital gain, and then I buy into a longer bond to lock in a longer return. That is some possible switching. But generally, a lot of our investors, from our observation, they buy and hold, right? And I believe a lot of investors buy and hold for a reason, because they know that this is a very stable investment. They don't have to worry about it. Okay. Okay. I think I'll answer this question. I think Mr. Chu, he is holding a Citibank USD bond, and Australian dollar Macquarie bond. I bought at a very high price then, with coupon rate of more than 5%, yet with so much talk of interest rates coming down, the bond price actually keeps falling. So the general idea is that if you have bought at a very high price, right, when back then when interest rates were lower, the bonds price converges to 100, right? Any bond will converge in normal circumstances. If the bond is being repaid, is going to be repaid without any issues. The bond price approaching the maturity will always go back to 100. This is how the market will trade the bond as well, right? Because people understand that, oh, this bond is going to be repaid at the end of the life of the bond. So if you bought at a very high price, what I'm seeing here, just by the looks of reading the statement, is that you bought at a higher price, you continue to hold it. When you bought it in, you actually locked in a yield, right? And that yield is what you assume to be getting every single year if you hold it to maturity. And that yield is promised to you, right, at that price. But if you look at the bond price, and given that the interest rate is going up today as compared to going down, and it is at a higher level than where we were when you first purchased it, the bond price would not recover to levels that you bought in my opinion, right? Unless we go back to a time where interest rates are approaching zero, which I don't believe that we will be going back anytime soon, right? Or even in the future. So this is the simple concept. The bond prices will always converge to 100. If you bought at 110, as it goes to maturity, it will go back to 100. The 10% premium you have already locked in is already factored into the yield that you are getting. Right? That is the yield to maturity, including the 10% extra that you have paid. Okay. Okay. Chocky have a question about buying treasuries dated to mature in 2050 at a price of 53.7. This is a very, very good question. The reason why is because it sort of looks very cheap, right? 53.7. And the reason why it's very cheap is because, first, it is paying a very low coupon rate. It is only paying 1.625%, right? You are buying a very low coupon rate, because the market, if the new bonds are being priced in the market, they are paying you 4%, right? So you're getting your returns if you hold this bond to maturity at the end of the life of the bond, because you're using 53 cents to pay for something that is worth $1, and the dollar will only come back to you at the end. Okay. Will it be high risk? It's also assessed from the duration of the bond. And when I say duration of the bond, it means that This bond is maturing in the year 2050. It is 25 years from now. It means that, just remember the example that we use for the Austrian government, that is a century bond, 100 years, right? And remember the formula of the bond price, right? It's all the present value of all the future cash flows. So if you have a very long bond, you have a very long duration bond, any changes in the interest rate environment or the expectations of the market's interest rate will affect your bond prices very, very severely. And that is also what happened to the Austrian government bond. So the risk is if the interest rate actually goes up, right? And in this case, let's talk a little bit deeper, right? If the US government interest rates, which is the long-term interest rates, 25 years interest rate actually goes up, then your bond price will actually suffer. So this is the risk that you are taking. And in my opinion, my 2 cents is that you might not want to expose yourself to such a very long duration. The reason why, because if you look at US government, you can just assess them as how you assess a person's repayment ability, right? If you look at US government, what would you conclude? You will conclude that, oh, US government is a government that has a golden credit card, right? The golden credit card does not have a limit. The golden credit card does not, you do not have, it has a low interest rate or even zero interest rate. And the bill never comes. Most importantly, the bill never comes. This is what we call a golden credit card. And by the way that they are borrowing, some players in the market is slowly to wake up and say that this is a math problem, right? It's a mathematics problem. At the end of the day, if I look at the mathematics, it does not add up, right? This guy is not gonna be able to pay me back my money. No matter if it's the US government, I can do a simple mathematics. I look at the debt. I look at how much they are paying in interest. I look at how much the government is earning in terms of their tax revenue. Unless there's something drastic being done, if I don't see it, I'm going to sell their bonds. Why? Because I fear that they cannot buy, they cannot repay me. So this is what's happening to the long-term rates or the long-term bonds of the US government. They are being, even though the interest rate is coming down, right? You hear that the Fed, the chairman or whoever, the Fed committee is trying to cut rates in December or whatever, January and whatnot. Although there's a loud voices to cut the rates, but actually the long-term rates is not reacting the same way. The long-term rates are actually going up, right? The market controls the long-term rate, not the Federal Committee. Right? The Federal Committee only controls the Fed fund rates, which influences the short-term rates. They have no control whatsoever on the long-term rate. That's why the long-term rates, it's a much more longer perception or longer expectation of market players on the country's finances. So this is the risk that we are talking about. Okay, so my advice, go for 10 years. I think 4%, 10 years is a very decent level. That is a much more bearable duration for us all to absorb. And we can actually comfortably get the cash flow and the yields from 10 years bond as well. It's not too far, right? The yield for 2050 is 4.9, roughly 4.9, 4.8, 4.9. The yields of the 2035 for 10 year is around 4%. So I would rather take that 4% rather than exposing myself to a lot of price risk. Okay. A question from Vino saying, what's the advantage of short-term versus long-term? Actually, it's a basket, right? If you can buy a basket. Short-term means that you will be getting your principal back earlier. Long-term means that you're getting your principal back longer. Longer bonds means that you are getting a better return, a higher return. Because when you lend somebody your money in for longer, if you lend them 10 years, you get 3%. If you lend them 30 years, of course, you're getting more than 3%. So it is a balance between the yield, the returns that you're getting from a longer bond as compared to how long that you want to keep the money in. Right? Of course, it doesn't mean that you cannot sell, but short-term bonds generally have a lower return. Long-term bonds generally have a longer return. So in the future, if you say, okay, I'm happy with 6%, I'm going to lock in for 5 years, then you know for the next 5 years you're getting 6%. Right? That doesn't matter how the market moves, as long as they pay you, you're getting 6%. Right? But if you're anticipating that the interest rate is going up, maybe you want to buy something shorter, because once it matures, your money you get back, you can invest in a higher kind of return. Right? But generally in the current climate, when the interest rate is pointing downwards, right, it's better to buy slightly longer bonds, because in the future, everybody is expecting the interest rate to come down. So if you buy a bond to lock in the higher returns, you're going to enjoy the higher returns for a longer time. So it's a balance again, it's a balance. Okay, though the bond is secured, Mr. Peter, we will not lose out in the bond price when we sell if not held to maturity, assuming interest rate goes up. If interest rates go up, then we will benefit when we sell. I think you got the relationship um, uh, flipped around, right? When interest rate comes down, right? When interest rate comes down, the bond prices goes up. Okay. The thing about security is that it adds a layer of safety to the bondholders, right? And most of the time, the companies would not default on their bonds because they don't want the bondholders to come after the company and get their hands on their assets too. So the incentives of the issuer is very, very high to make sure that they pay back the bonds, right? So again, when interest rate comes down, the bond price goes up, and you can actually sell, right, in between. You don't have to hold to maturity, and if the bond price goes up, you can actually capture some of the capital gains as well as on top of the interest that you have earned throughout holding the bond. I have a question from, maybe I'll just take another two more questions because we have already gone on for a very long time. Maybe I'll just take maximum 2 or 3 questions. But let me just quickly scan through the rest of the questions so I can pick the best questions that we can learn all together. US Treasury bills. This is a quick answer. If you want to buy US Treasury, the starting point is 100 nominals, and we have a campaign that is ongoing to allow you to get $5 for every trade that you trade. Let me see. Okay, I think this is a question from Clarence, from one of our advisory partners. Clarence is asking, there are many advice out there, just putting, if there is uncertainty in the market, just putting EPF and earning an average of 5%, 6% every year is very good compared to bonds. I mean, I totally agree, right, Clarence? You made a very good point. In fact, if you ask me, the first thing that you need to maximize is actually your EPF, right? If you can make additional contributions to your EPF, feel free to do so, and you get tax benefits out of it as well. So from a option point of view, okay, if you have maxed out your EPF, right? Even your additional contribution of 100,000 a year, if you have maxed that out, I mean, please do so, right? Max out the EPF, because they are a very professional body handling your retirement money. The only thing that is between you and putting your money into EPF is that whether or not you need access to that liquidity, right? Because putting your money in EPF means that you got to set it aside until your retirement, right? So that is another consideration. If you have no need for that liquidity and you are very sure that this money is meant for retirement, go ahead, please. And I would advise to maximize the EPF, and let them do worry for you, right? Let them work, because they are professionals. But if you have a liquidity need, right? If you need that money, and you want to build your cash flow portfolio, then bonds can be an option also, because you can possibly build a 5 to 6% stable, high quality portfolio by getting bonds as well, right? So it's a different thing and I think that the essential thing that you need to consider is whether you need the access to the liquidity, right? Okay. Um, Let me quickly look at the last question that I can answer for everybody. Please, I mean, thanks for all the questions. If you guys really want us to answer your questions after the call here, please reach out to us. I mean, you have our CIS contacts, you have a general line. You can drop your messages to us. I'm very happy. I'm really, really happy to see a lot of interactions here, but because of the time, we cannot answer them all. I can only answer one more. Um, Let me just quickly pick out one one question. I think there's a very, very nice question to end our call here, end our session here, and it's by an anonymous attendee, and he asked actually, bond is fixed income? Question mark. How? This is a very, very nice question to end our call. The reason why is because, yes, bonds is under the big umbrella of fixed income, right? Fixed income, you have other products, including other types of things that generate fixed income, right? And the reason why bonds is so simple is that if you buy something today and you look at the price and it says that it's gonna pay you 5% for the next 5 years, every single year, that is gonna be fixed. And that is what I mean by fixed income. And another aspect is that even if the bond prices goes up or goes down and you have no intention to sell, and you know that you're buying into a bond that is issued by a high quality company and they have little risk of default, the fixed part is that you're still getting back your whatever the returns that you paid for, right? The 5% that you initially entered. Once you buy into it, if you don't do anything and you hold it, continue to hold it every single day until the end of the maturity, you know exactly from today onwards to the maturity of the bond, every single year you're getting 5%. That is a very beautiful product, right? Because it gives you the certainty. You know that if you're buying into a high quality bond, you're getting every year 5%. And that actually frees up a lot of our personal time to do something more important. And that's I think the most important thing about investing, right? Giving us the freedom to do whatever we want. We don't want to be checking our phones and looking at our portfolios every lunch hour just to worry about our portfolio. That's not the way to invest and live our life. So again, the ultimate goal of investing is to preserve and grow your wealth. For the rest of the questions that we are not able to answer, please do drop us an email or even reach out to us through our CIS or general line. Get them answered. We will be very, very happy to answer them. But for now, we have to close. And maybe before I end, I just want to wish everybody a very early Christmas and a Happy New Year. And thank you for being with us for the past 25 years. And I'm looking forward for the next 25 and more. I'll pass the time back to Mark. Mark, do you have anything to close?
Yes, yes. Thank you, Mr. Tan, for your presentation and help in addressing our participant doubts. So, as Mr. Tan said, let's say if you have any more questions, right? So kindly feel free to email to investhelp .my@fundsupermart.com. So we from there we able to reply you. So before we wrap up, just to highlight, there's a few campaigns are ongoing. The the first one will be the trade and earn US Treasury campaign, okay, which is you're able to trade US Treasury and earn up to 15 USD. But this campaign will end by 31st December. So kindly go and look at our FSM1 website for more details. And there is also, let's say we find this platform is quite easy and friendly and useful for your investment journey. You also can refer a friend and both of you will have about 25 ringgit each. Okay, so try to look at the information in our website because of running of time. I don't want to go through the website page. And now it's the end of the year, and I remember we are always planning on the tax planning, right? So we also have an ongoing PRS campaign. which is once you invest 3,000 into a participating fund out PRS funds, you will get a 40 ringgit into your cash account. And this one also, the campaign will end by 15 December. So if you haven't done your contribution for this year, quickly log into our FSMOne website and find for more information. Okay. So, and lastly, for a small booth today can make a big difference in a long-term planning. So again, ladies and gentlemen, we hope this section added value to your investment decision and your investment journey. So with that, thank you everyone for joining. Have a good night. Thanks, Mr. Tan.
Good night, everybody. Have a good night. Bye bye.
Good night. Thanks. Bye.